Welcome to our briefing for the committee chairs. My Brian, I'll be introducing this morning's program. In addition to those of you who are here, we are also live streaming this presentation to a couple of dozen chairs across the state. The aim of these sessions are really about providing you with information that would be useful in your governance role as it relates to our two service lines in relation to which are our financial audits and performance audits. So we've got three speakers. The first one is going to be Daniel Bird, who is going to share with you our performance audit topics for the next 3 years. It's currently out for consultation. And then it's 30 June is around the corner, so the technical update is going to be fairly focused on those areas you need to have a look at in terms of those financial statements. Karen Johnson is going to provide an update in terms of what's changing in relation to the QAO audit opinion. She's also going to touch on that pesky related party standard, which, a few years back when we were aware of the extension of this standard to the public sector, I never envisaged the amount of emotion this standard would bring. And I think Karen is the best person to ask all your questions around the standard. She's also going to touch on what we're doing in terms of asset valuation guidelines, as well as how we're planning to assess timeliness and quality of financial statements this year. Our final speaker is going to be Yearend Close, who's the acting Auditor General, and Anthony is going to share with you the lessons learned from our reports, as well as it's going to go through some of the high-level recommendations from the strategic review of QAO. So QAO is subject to an external review every 5 years, and Anthony will go through what are some of those key recommendations in that report. So we might get the briefing started. Over to you, Daniel.
Thank you, Brahman. So we thought this morning we would share with you a little bit about what performance audit is doing. We're always doing lots of things, but something that's been taking our attention recently is the update to our strategic audit plan. So those of you who have been to our briefings before know that by 30 June each year we have to put an update of our strategic audit plan on our website, and that lists a 3-year rolling program of the topics that we plan to do in performance audit. So we thought we would share with you today a little bit more about some of those topics that are coming up and the agencies that might be affected by those audits. So in building our plan, we're really mindful that we've obviously only got a certain amount of appropriation, so we want to use it wisely. So we want to pick topics that are going to have the most value for the sector. So each year in revisiting our plan, we have quite an extensive process that we undertake internally, where we look at all the potential topics and go through quite a rigorous prioritisation process, and then come up with the years in which we think it would be most valuable for us to approach those topics. In doing that, we also look at what's going on both globally, nationally, and of course locally, and the impact that might have on the delivery of the public sector services and also the topics that we want to have a look at. So some of the things that we call out in our strategic audit plan report you'll see this year some of the continuing themes are things like the globalisation and digitisation of services with what happened over the weekend. It reminds you just in terms of how close the world is getting when you can have a cyber attack that affects, internationally. The ageing population, it's another one of those themes that continues to impact many government service delivery areas, but particularly the health sector. Consumer expectations, there's certainly no easing of that desire for increase in responsiveness of service delivery, and certainly more of a personalised service is what our consumers are asking for these days, and also a desire to get involved in the design of how services are to be delivered. Natural resources is also another topic that's quite heavily discussed at the moment with what's happening interstate, with concerns around reliability of our energy sources and that continued investment in renewable energy. Urbanisation is also another one that we continue to see have quite an impact on government service delivery. We're doing an audit at the moment on planning infrastructure, so that's certainly one with the pressures on that continuing urbanisation trend. In terms of Queensland, innovation, investing in innovation, it's certainly continuing with the Advanced Queensland agenda. Regional employment is another key focus area. Investment in capital infrastructure and a number of key programs are keeping the government busy in terms of the NDIS, child safety and domestic violence, another continued focus area. So these are some of the things that are influencing the topics that we have selected for our program. So in terms of the lineup for our 2017-18 program, you'll see a number of audits there that follow on the financial accountability and sustainability theme. So the first one, for instance, investing for success, is one in the education sector where there's been specific federal funding for schools, and the federal budget indicates that sort of funding is likely to continue. So we're doing an audit there to see how well the schools have invested those funds and the outcomes that they're getting for students. Another one that's on the financial theme is the finalising of unpaid fines. So instead of looking just at our state penalties and enforcement register, SPUR, we're actually looking at some of the entities, processes that feed those fines through to SPUR, like DTM and the courts. Then we've also got our next local government audit is in the rating practices area. So we did in 16-17 financial sustainability of local government audit and decided that we're going to do a series of audits for local government where we then break down the various elements that we want to look at. So we're looking at the rating practices this year. We've got another one coming up in the asset space, and then we'll also look at the cost component of it as well. Then on the theme of the digital innovation, adoption of digital technology, we've got both the monitoring and managing of information technology projects where we're going to look at the ICT dashboard and the reliability of it, as well as the rigorousness and effectiveness of the project and program management that the government's employing in some of the major ICT programs that are running. And we've also got the digital hospitals audit on there. We'll look at the 2 hospitals where they've already implemented a digital hospital approach, but then we've also got another 4 hospitals that have done the EMR, so the electronic medical records component. Then there's a few audits on there that speak to the changing models of service delivery. So the NDIS is one of those. There's some major changes to service delivery in that space. So Department of Community has to have that rollout completed in 2018. So we're in and commencing that one imminently around the readiness of the state to put that service delivery approach in place. And then we've got one on social housing. So social housing is another one where there's a new government strategy coming out, so depending on timing of that, but there's certainly some different approaches that Department of Housing have already put in place that we'll be able to have a look at the effectiveness of some of those, even, the subsidies to keep people in the private sector, for instance. So we've also got a fraud risk management one there. So we've got a continuous theme of looking at fraud risks. We've obviously done it in three state departments a couple of years ago. Last year we did it within the local government sector. We've got another 4 agencies that we're looking at fraud risk management at the moment. So that'll be one of those ones that you'll see every couple of years at least. We'll touch on again. It's one of those ones that we need to continue to look at in terms of the risks in that space. And use of confidentiality clauses, I think, is the last one there that I haven't touched on. So it's more of a transparency of information one where we're looking at the appropriateness both where they, the clauses are being used, where perhaps they shouldn't, but then also are they not being employed where we should have them. So we'll look at it from both sides. Audits that we're doing, so the asset management one is there in 1819. We've also got cybersecurity, so with the risks I mentioned at the front end of the discussion, so we will do a cybersecurity audit in 1819. We debated when was the right time to do that one, but we felt that 1819 was going to be most beneficial once agencies certainly get on board with and make sure that they've got rigorous processes in place there for us to come back in and make sure they're keeping those up to date. And we've got another infrastructure one coming up there as well with the major projects and market-led proposals. In terms of 1920, I won't go into much detail because the further out we go in terms of our program, as I said, because we come back in and revisit it each year, things are likely to change depending on what are the priorities and pressures and challenges for the government at the time. But there's a list of 15 potential topics that have made it sort of to that third year that we're calling out there in our strategic audit plan. So in terms of how you can help, so Brahman mentioned at the front end of the discussion that this current year's strategic audit plan is out for 42-day comment with Parliament. We've also issued it to each of the agencies for comment, so the chief executives of each of the agencies have had the draft plan for comment. So we do ask you to, be proactive, have conversations around it in your audit committees. Certainly the sector directors are happy to meet with any of you to discuss topics, thoughts on those, both the ones that are on there, but also any new ones as well, new and emerging, risks or issues that you see that you would like to have on our upcoming agenda. And where you can log them is on our website. So a plug for Lauren, our communications manager. In terms of our website, we have a very easy way of being able to submit topics. So you can see that middle box there is suggest a performance audit topic. So you're welcome to get on and do that. There's also the contribute to performance audit topic there as well, which we get a lot of interest in recently as well. So it's another good way of contributing to our audits. In terms of the ones that we have in progress, so we've got a couple that are going to be tabled in the next month. Government advertising is one of those. It's already out for 21-day comment, and actually organisational structures is not on there. Organisational structure and accountabilities is the other one that will be tabled in the next month. Coming up after that will be, we've got security of critical water infrastructure, which is actually looking at attacks to our critical water infrastructure, so another topical one for the moment. And then our Aboriginal and Torres Strait Islander education and employment outcomes will also be tabled within June. After that, we're looking at our managing mental health, so which it will be probably most likely late June or July, and our integrated transport planning one, which I referred to a little earlier. The last one that's listed there, the confidentiality provisions in government contracts, is the first of our 17-18 plan. And if you're in any of the agencies where we're kicking off, there's a number of those 17-18 planned audits that are kicking off at the moment as well. So you might be hearing about some of those. This is a list of reports that we have tabled for this year, so we have been very busy. And I just wanted to call out, I know we're going to touch on wider learnings later in this morning's program, but there's just a couple of things that keep coming out in the audits that we're doing that I wanted to raise with you. And one of those, I was talking to one of the chairs before, over tea, the quality assurance of performance information. So even when there's those rigorous processes in place around the financial information, it's the performance information that's also publicly reported that it never ceases to amaze me that there isn't the same level of rigour applied to. So there's just time and time again, strategic procurement was one where we called that out. The monitoring and reporting of performance, we called it out again, and then recently in our criminal justice data audits, so the crime statistics one, for instance, there is just that issue around the lack of quality assurance over the data that's being publicly reported. The second theme that we're also seeing is the accuracy of asset registers. So that's another key one when government is such, a huge owner of major assets to not have that same attention on the asset registers and the impacts that has. So forecasting long-term sustainability of local government was one of those ones, and that's one of the major recommendations and programs coming off the back of that audit is looking into improving the rigorousness of that, and then efficient and effective use of high-value medical equipment. So in the health space, there's also a program of work that's been initiated off the back of that to look at the accuracy of the asset registers with that high-value medical equipment. So lastly, we just wanted to share with you a reminder that, so there's a long list of reports. I do encourage you to get on and have a look. There's a lot of good information in those reports, but if you don't have a lot of time, then you can also listen to them. If you go onto our website, each of our reports, we do a 5-minute overview, 5-minute video overview, which you can just listen to get the key highlights from each of our reports. So that's a quick way of also getting across that long list of reports.
Before I give you the technical update, I'd like to give you a quick update on some changes to our technical team. So up until December 2016, the technical and treasury products team was led by Rachel Vagg. Rachel's now moved on to be a sector director in the energy sector. It's a very good fit because it's probably our technically more challenging sector. We now have a new technical director. His name is David Hardage. He was formerly the technical director at EY. He's got probably a good 20 years experience in providing technical information, and the last 10 years of that has been certainly within the Queensland and giving a lot of information to the Queensland public sector. So this is what I'm planning on covering today. It's a bit of a long list. First of all, the changes that are going to impact the audit process for this year. The first one of those is the change to the form and content of our audit reports. We are adopting long-form audit reporting and we'll be reporting key audit matters. Secondly, I'll go through the implementation challenges that we're having with the introduction of the related party disclosure standard. It has proved very challenging in the public sector to implement. Then we'll look at some future changes to accounting standards that aren't applicable until future years, but they're going to start needing your oversight shortly. And they're the changes on revenue recognition, particularly as it comes to grant accounting, and the changes to leasing. We are responding to the lack of information out there on valuing public sector assets, particularly when valuing them at fair value using current replacement cost. So we're launching a better practice guide, and I'll go through the reasons why we're launching it and how you can contribute to it by providing feedback. And finally, over the last few years, we have been promoting better financial reporting. We've been promoting at many different ways through our Insights magazines, through CFO forums, through our client technical sessions, financial reporting, simplification, better disclosure and better presentation of risks. So we'll give you an update on how we're going with that. So first of all, key audit matters. QAO is not obliged to report key audit matters. None of your entities are listed entities, but we have decided to issue key audit matters for what we consider to be significant public sector entities. And generally that's going to be all departments and all of the larger government-owned corporations or larger entities that spend funds to contribute to major policy. That's both federal and government and state government funds, so your HHSs and your universities. So we're unlikely to go beyond significant public sector entities at this point, unless there's something unique or complex about the particular audit that the engagement leader feels that they need to be producing this extra reporting for. The Australian Auditing Standards Board is currently revising the standard on key audit matters. It's only being implemented for the first year this year, but it's now currently in revision. What they're considering is the need to apply it to public interest entities. So if anything, we're just a little bit ahead of the legislation. The local government key audit matter trial will commence this year, but full implementation is still a few years away. So the 2016 audit closing report should have provided you with some insight as to what our key audit matters are going to look like. If your entity is having a key audit matter, it should have been included as an appendix to that closing report. The 2017 report will look very similar to that. However, this time it's going to be included in the financial report. The 2017 key audit matters shouldn't be a surprise to you. We report all of our significant audit risks within our audit planning process, and it's formally communicated to you through the audit plan. We'll be narrowing down those significant matters into the matters that we've spent the most audit time on. So the most things that matter most to our audit are what we'll be reporting as CAMs. You may have 20 significant risks. We'll be narrowing it down to 1 or 2 CAMs. So most clients will only have 1 or 2 CAMs, and they're generally going to be things like valuation processes or revenue recognition. Those entities that are going to have more than 2 CAMs are ones where there are some fairly complex accounting or unique issues. We're talking things like derivatives or unlisted investments. So what the CAM will look like is it'll be presented with a paragraph that explains why the matter was considered to be of most audit significance. Okay. That paragraph will then be followed by a table which details the key audit procedures that we undertook to acquit our audit risk. Now, it won't be all audit procedures. We often do, our steps can go for pages and pages, but it will be the key ones that you need to know about. There's no separate conclusion in the key audit matter. So we're never going to say, if we're writing a CAM on valuation, we're never going to give you a separate conclusion on that CAM. The overall audit opinion will remain the same. We're currently in the process of reviewing all of your pro forma accounts, and we're going to be paying special consideration to the notes that relate to the key audit matter. So those notes really need to give the reader a full understanding of the accounting treatment, the materiality and risk of the balances. Our key audit matter is not going to comment or provide any additional disclosure information. We expect that that is full in the accounts, fulsome and accurate. These reports are going to go through an internal QA process. We have constructed templates for what we see are the likely key audit matters, but they're going to have to be very heavily tailored to your individual entities. So the QA process will make sure that there's consistent tone and depth. The CAMs, as I said, is the first year of implementation, so they're very new to the audit profession. We are expecting to see them evolve over the next few years. A few weeks ago, we were at a roundtable discussion with the Auditing Standards Board, and there was a mix of the Big Four, chairs of audit committees and QAO, and we shared some of the challenges we're having in implementation of this standard, and there were some unusual CAMs that were brought up. So, for example, Telstra. They have a key audit matter on IT general controls. The basis for that is that the revenue and billing cycle is so integral to their financial report that they had to go through the IT general controls in such depth that it was a key audit matter. Now, the key audit matter standard is not written to consider key audit matters on internal controls. So that was one from left field. There was also an international one that commented on the qualifications and effectiveness of the board. Again, don't think those auditors were reappointed, but that to me is probably beyond the scope of what the standard ever envisaged that key audit matter to be. There is another change to our audit process when it comes to reporting this year. Australian Auditing Standard 720 applies from the 30th of June 2017, and auditors are now required to review the annual report to ensure that the financial information and the non-financial information is not inconsistent with the financial report. So our audit opinion doesn't change, and the extent of our audit testing isn't extended on this. However, we have to consider that additional information. And there's two reasons why we need to do that. Firstly, if that information is different to what's in our financial report, it could indicate that our financial report is materially misstated, and we may have to go back, do additional testing and reissue that report. But it could also indicate that management is trying to mislead the readers. And they could be misleading them through inaccurate or false information or through omission or obscurity. So that's something we have to consider as well. And we need to review this report regardless of whether it's produced before or after the signing of our audit report. So as auditors, we're going to have to understand the timing of that publication. We're going to have to request to see draft versions. And in the likely event that our audit report is signed prior to the annual report being available, we need to have written representation from management that they won't issue the final annual report until we've provided clearance on it. So that may impact the timing of the annual report, but we're certainly going to work with our clients to make sure that we have clear understandings of when the report will be available for review and the turnaround time that they expect of us. So AASB 124 is the related party standards, and it's been very challenging to implement within the public sector. I think there's two reasons for that. The first one is the confusion between influence and probity. This standard is not a fishing exercise for undisclosed probity matters. Its objective is to disclose the people, the entities and the transactions that can materially influence the reported financial statement disclosures. The other aspect is our audit need to be able to test completeness. We are asking for very granular information, but there's no way that we would be reporting most of this. It's just to facilitate that audit process. So just a quick recap. Key management personnel are now defined as the executive team and the minister or the shareholding minister related to your entity. We have to disclose the remuneration of those key management personnel. Now, that's no different to what we've disclosed in the past for the executive team. However, we will be bringing ministers in. But just are reminded that ministers are unlikely to be paid by your entity. They're paid centrally. So the disclosure on remuneration really shouldn't change that much. We do have to now record the transactions between the key management personnel and their entity. The materiality for that will be based on the entity. So it will be different depending on the size of the entity. We're also disclosing transactions between key management personnel and whole of government. Now, whole of government has a huge materiality, so I'm not expecting much disclosure here at all, but there could be some. We also now need to disclose transactions with other related parties, and that includes close family members and their companies. Now, over the last 2 years, QAO and Treasury have worked on providing guidance on this implementation, and we've worked very hard and provided a lot of guidance. We've agreed on the template disclosures for the declarations. We've agreed on certain materiality type limits, and we've provided guidance on privacy issues. We've also issued work examples and disclosures. We do expect that each individual entity will be fairly well progressed with gathering this information by now. Ministerial information is going to be collected centrally. It's a sort of a combined effort between Department of Premiers and Cabinet, Treasury and the Integrity Commissioner. So that information will be provided at a later date to your entities. So based on the extensive guidance that we've provided to date, we do expect that the finance team has processes in place to identify, collect and analyse all the information from the 1st of July 2016 for KMP and ministers. Now that includes anyone who has left during the year. We still need that information. It's been a fairly stable year this year. There hasn't been too many changes at a ministerial level. However, when there are elections, it's going to be a problem. People have moved on. They don't want to provide this information. So we are working to make sure that there are processes to collect this information progressively. The finance team should have also, at this stage, assessed the materiality of any transactions that have been reported. So if it's something that is material, we need to assess on whether it's been made on normal terms and conditions. If it's immaterial, we need to be able to write it off we need to be able to have good assurance that it's clearly trivial or it's a normal citizen transaction. We also should have expected to see draft disclosures now, and we're looking at pro forma statements and we'll be looking at the draft disclosure notes. Our general assessment is that there is a very low level of preparedness within the public sector at this point. We're just seeing issues starting to bubble up to the surface. So these are the questions that we think that you as an audit committee need to be asking the finance teams. You need to really undertake a readiness assessment to determine the level of future input that you need to put into this process. It's the first year of introduction and it's quite likely to require quite a lot of your oversight. So we are expecting it to be very advanced at this stage within the agency. Ministerial information is not going to be provided until July, probably late July. So there will be a bit of pressure put on the completion of the financial report. Hopefully some of your audit committee papers and presentations will have covered these areas by now. If they're having trouble getting that information out, we're happy to help. So once the agency has completed those steps, your oversight role comes into play. And you need to be satisfied that your agency gave appropriate training and guidance to the key management personnel so that they could identify who is a related party and what transactions with that related party need to be disclosed. We'll need to see that all declarations have been complete and that all parts have been answered. One of the issues currently bubbling up to the surface is that in the last few weeks we've been made aware that some KMP have indicated that they won't be completing declarations or they won't be completing all of the declaration. Your role is to assess that, and to consider what impact it's going to have on the completion of the audit in terms of timeliness and the cost of the audit. You also need to look at that declaration and assess whether that information is reasonable based on your knowledge. I'm not expecting you to go over and above that, but there still needs to be a level of reasonableness assessed on that. We have noticed that there are changes this year to people nominated as key management personnel. We ask that you be sceptical of that, because we're being very sceptical of it. Now, if something has changed because of a corporate restructure, fine. But otherwise, we want to know why someone was KMP last year and suddenly they're still same roles, same responsibilities, but they're no longer KMP this year. As I said, it's been very challenging to implement. There are some significant changes to accounting standards coming up in 2019, but they will have 2018 comparatives. And some of the nuances around them mean that it's important that you start looking at them now. I'm going to discuss the changes to revenue in terms of grant accounting and leases. I'm going to ignore the one on financial instruments, because we really have been if your entity has complex financial instruments that this applies to, we've already talked to your audit committee about the introduction of them, because you should be well underway, because I think it's next year that you have to start reporting them. The next few slides are a summary of what we've already shared with the public sector to date in our client technical presentations. I'm not going to go into in-depth accounting here, because I don't want 50 faces suddenly going blank. But what I will go through is what your role should be in that oversight process. It's really just for your information at this stage. Your oversight process will take, I guess, a ramp up in 2018. But I would say don't wait for any Treasury guidance on this. It will come and we will work with Treasury, but historically it's always been a little too late. So first of all, grant accounting. So under the current accounting standard for not-for-profit entities, if you receive significant grant funding, you're going to record that funding as revenue when you receive it. And that's because the recipient of the grant has effectively gained control over those funds. So really, regardless of any terms and conditions that have been applied to you, you own those funds and you can do whatever you like with them. So that's why they're revenue. There's long been complaints that this distorts the bottom line and that cash inflow is not matched with cash outflow. And the distortion in the bottom line can lead to some very, I guess, adverse future consequences. And we have been provided with some very valid, valid reasons and explanations of that. And it is a perception that you have to deal with. You know, people are not patient enough or not understanding enough of the accounts to look at your bottom line over a 2-year period. They see $1 million profit one year. They don't look for the $1 million loss next year. They just say, you've got $1 million surplus, you're overfunded. So we can understand the angst it's caused. So under the revised revenue standard, there may be some ability for the grant funding to be deferred into a future accounting period. But this only applies to reciprocal grants. So if it's a donation or a gift, it can't be deferred. So if your entity has significant grant funds and your finance team has come to the audit committee and advised that the accounting treatment will change in 2019, you'll need to get some sort of paper that assures you that that is the correct treatment. And what you'd be looking for is a paper that identifies the type of grant funding, when and how it's going to be spent over what financial periods, and if there is a proposed accounting change. And you then need to get someone to review the grant funding agreement terms and conditions to ensure that it actually is a reciprocal grant. So quite often there are discussions about these grants between the grantee and the grantor, and they come to a good decision about how they're going to use those grant funds, and for all their intents and purposes, it's a reciprocal funding arrangement. But then when they get the legal agreement, which hands over the funds, it's often not worded in that way. Okay? The lawyers get involved and it's no longer a reciprocal agreement. So What we're asking is for the finance teams is to review their current grants, because it then gives them 2 years to get those grants rewritten in their favour. Okay, so that's why early engagement on this one has been so important. We also will be sceptical of any changes in grant funding too, because of that motivation to create a bottom line. Leases, this one is a bit of a confusing standard. Our technical director calls it living in a parallel universe. So under current accounting standards, only finance leases are accounted for on the balance sheet. All other leases are considered operating leases and are disclosed through the commitments note. By 2019, all leases need to be recorded on the balance sheet. So, for example, the rent of a premises. You have a right of use asset, which is the cost of renting that premise between 2019 and the end of your lease, and that's offset by a liability, which is what you're going to pay over that period, discounted back to its net present value. But it's not a one-to-one relationship, it's not a one-to-one offset. So there are some issues that you're going to need to consider, and the next 2 slides are what we're talking to the finance teams about. So under this standard, there's a much wider definition of an operating lease. It's wider than the current commitments note, which is generally just your operating your rent on premises. So any commitment that goes for greater than 12 months and totals greater than $7,500 is going to be captured under this standard. That's going to be quite a long list for some large entities. You know, we're talking photocopiers, printers, communication contracts, IT maintenance contracts. It's going to be a long list. And someone's going to have to review all those contracts to make sure the terms and conditions, particularly escalation clauses, are recorded correctly in the asset base. It's going to be a large exercise for departments, and you'll need to assure yourself that the list is complete. So it's important to start this now. And accounting for those additional leases is not going to be a straight offset of an asset and liability. The required accounting treatment is going to result in operating leases being front-loaded with liability, and the lease expense in the first few years is going to be greater than the liability reduction. So if your entity generally budgets for a break-even position or a small surplus or net operating position, it's going to have significant impact. If I use QAO as an example, in 2019, we're going to have 10 years remaining on our lease, and we pay about $2 million annually. So we're not big in terms of the public sector, but when we account for that lease, by our calculations, in the first year, the impact is going to be $300,000 to our bottom line. So that's a big hit for an agency that aims to break even. So don't underestimate the impact this standard's going to have on your profit position. So the government is steward of Queensland's public sector assets, and the valuation of these assets continues to be the most problematic part of our audit. It's the area that records the most audit errors and the most adjustments. And these assets are often unique to the public sector, and there's limited guidance on how to account for them from the professional bodies. We've been researching and consulting for about 2 years over the contents of a better practice guide. We determined it was critical in 2016 when there were changes made to the fair value accounting standard, and there was very little guidance on public sector or not-for-profit implementation. So the feedback also from our clients to the strategic review process was that they really wanted to perform accurate asset valuations, but they were a bit of a loss as to what was really required of them. So today is effectively, I guess, the soft launch of our Better Practice Guide. It will be available early next week for feedback. This guide covers only assets valued using current replacement cost, which we used to refer to as depreciated replacement cost. Assets that are valued using discounted cash flow or other market-based methodologies are well explained in current accounting literature, and we don't intend to duplicate that guidance. But current cost current replacement cost valuations are generally unique to the public sector and are very complex and require significant judgment to be exercised. But this guide is not just about getting the accounting correct and getting the right number in the financial statements. The information used in the valuation process is also the critical information to inform asset management plans and future investment decisions. And we want the public sector to get that link. Valuations are not just a numbers exercise, it provides valuable information to manage assets. It's a very technical guide. I'm not going to sugarcoat that. It's not something where you can just read the executive summary and get an idea about it. And you can't skim through it either. It is a very technical guide. It's been written with a wide range of users in mind, and it does have a lot of practical tips and checklists for audit committees. Because it's written as a very technical guide, we've structured it to have the body that explains the required accounting treatment. It provides practical tips on how to apply those accounting standards and gives some very generalised examples and case studies. Attached to that document are a series of appendices that provide much more detailed specific information. So, for example, specialised buildings, road valuation, how to handle an interim valuation, audit committee papers, the questions you should be asking. Our intention is to add more appendices where we see the need for it. So if a client came to us with a particular issue and said, look, I've tried to apply your guide to it, I think I'm only getting halfway, I need more guidance, we'd probably use that as another case study and add to the appendix. And it's one of the benefits that you can have by having an online document. You can just continually add to it. So we are requiring some feedback. The guide's now available on our website. It will be available next week on our website. We will be sending you a link to it next week. We'll also be sending a link to this slide pack as well. We're requesting feedback from those in the public sector who are going to use this guide, and you're one of that stakeholder groups. So any of you out there who have significant public sector assets, I'd encourage you to read it. You might need to put aside a couple of hours because I said it is a very technical guide. But we would appreciate any feedback on the areas which you still feel have inadequate guidance to support those charged with governance. So finally, I'm going to touch on the timeliness and quality of financial reporting. We've been reporting on this annually. It's been something that we've had many campaigns over. We reported on simplification. We report on timeliness and quality. Overall, we are observing some good improvements. There were some slow improvements at first, but I think it's gradually our messages are getting out there. Timeliness and quality are two very basic but important measures. So over the last few years, we've concentrated on them. There are other measures that we consider, and they include the year-end close process, internal controls, and management oversight and risk. And we're slowly introducing these measures into our reporting. We report using a traffic light system. It's very simplistic. Please don't look at it as a report card. This is produced to show risks, and it's your role to monitor the risk management process. So if you see a traffic light that's amber, it means that there is a risk in your organisation and you need to have oversight as to what's being done to mitigate that risk. If you see red, it's time to panic. This year we'll be measuring, timeliness as the first thing. State government entities have a reporting deadline of 31 August. Last financial year, 84% of entities met their reporting deadline. That was an improvement over the 74% of the prior year. Councils have an extra 2 months, up to 31 October to report, yet only 86% of councils meet that deadline. So there's still room for improvement. And the real room for improvement is the fact that over half of those statements are received into our office in the last 3 days before 31 August or 31 October. And that poses a number of challenges. It really means that the agencies are left with very little time to resolve any issues that have been raised by the executive or the audit committee. If they're only getting the papers a couple of days before we get them, very little time. But it's also a processing challenge for us. It can be physically very challenging to process that volume of accounts in 3 days, particularly if there have been changes to the set of accounts that we saw a week before. So we will be measuring the traffic lights to an agreed date. Now, every agency will have a different agreed date. We've agreed it with them based on their capabilities and their capacity. So to get a green light, we need to have received the statements on the date that we agreed. If you get an amber light, it's 2 days late. After that, it's a red light. But the date that we've agreed is no later than the 15th of August. So that allows a 2-week turnaround for the audit committee to be able to review the final draft statements and the executive team to be able to review it. So there's still 2 weeks, but we do need a good set of quality accounts to be able to achieve that. So to meet those timetables, our auditors need to be provided with a good quality version of the draft financial statements. And what I mean by a good quality version is the set that the agency considers appropriate for the key executives or the chairs to sign. We don't expect to see any significant adjustments post that point, and that could be adjustments proposed by management or adjustments proposed by audit. All of the auditing issues and accounting issues should have been resolved by the time we get those statements. We also don't expect that any immaterial changes will be made to the financial statements. So as we go through our audit process, we quite often find immaterial audit errors. And what we do is we record them on a schedule of unadjusted audit differences, which we call our audit scorecard. And at the end of the audit, we'll sit down with management and we'll say, look, these are the little errors we found. You know, they're not material, but we think you should know about them and improve your processes for next year. And management at that point will quite often say, oh, good, you found that one. We've found this one, and this one as well. How about we change them all? We don't want that to happen because they're not material. They don't impact the decisions that the users of your financial statements are going to make. But it takes time to audit the changes. So every change flows through the financial statements and affects multiple statements and multiple notes. So we don't want these immaterial changes to be made. And that's factored into part of our traffic light system as well. So what we've determined as the key driver to timely and quality financial reporting is the rigour behind the year-end reporting process and the year-end close process. So up there are 5 steps which we think are the key things to be done to get a good year-end close. Now, not all agencies will have those 5 steps, but there'll be at least a couple of them apply to your agency. Now, these steps and the dates proposed up there have been as advised by the Under-Treasurer to your agency, so your agencies are required to do these. This year we're assessing these steps against dates agreed between the client and the auditor. So in some cases they may have their non-current assets cleared by 31 January. If that's the case, well, that's the date we agree on. If they say, oh, look, we just don't have the capacity and the capability this year to get it done by that date, we'll agree on, say, the 30th of June. But we are trying to make sure that those, in the future, that those are the last dates that it happens to. So the greatest impact on meeting our, timeliness and quality are asset valuations, but it's also resolving known accounting issues, resolving those technical issues that were either carried forward from the prior year or have appeared this year, and better pro forma statements. So the drafts that we're getting should be almost final drafts. It means checking to make sure that there hasn't been any changes to accounting policies, or if there has, it's been adequately disclosed in the accounts, that comparative disclosures have been updated, including the narrative, and any changes in your operations or structures or risk are now disclosed in the financial statements. So all of these will be reported in our closing report. And as I said before, the traffic lights are very simplistic, so your engagement leaders should be providing context around them. This is what we'll be reporting to Parliament. I know it's a busy slide, but the general gist of it is to provide a simple visualisation of our audit assessment and to allow comparison between entities. And there will be context about this in the report. It shouldn't be thought of as a scorecard. And we are aware that these simplistic measures are causing some angst amongst the finance teams, but the aim is not to target or embarrass individual agencies, but to get to an overall picture of the maturity of the financial reporting process and to identify the areas of risk that those who are charged with governance need to have greater oversight of.
Well, good morning, everyone, and thank you very much for your attendance. And I hope you got a lot of value out of Karen's presentation. There was quite a lot in that, and certainly only scratching the surface of some of the impacts that are coming up. When I spoke to you last time, for those that were able to attend, I spoke about the performance reporting, performance information, etc., and it was based largely around a number of performance audits that we conducted in that space. Report 18, 2013-14 around the reporting information across government, and then also the follow-up. And I recall at the time, Bob Gross, who some of you may know as well, he asked me the question at the end around he sort of made the observation of we should probably be doing more in this space. So today I really wanted to build the case for the Audit Committee's role in performance management, performance reporting, etc. But first I'd like to take a slight detour around our strategic review. Perfect, thank you. We've just had our strategic review done, and I'd like to just give you a quick overview of our process and also the outcomes and recommendations that were there, but with a view to how you may use it as the governing groups across those areas. Is everything right, mate? Yeah, just Is this going to take long? Can I keep talking?
Yep, keep talking.
Okay, good.
Go for it.
So the
Sorry for the distraction.
no, it's okay. Do you want to do it? I'll go sit down.
Yeah, sounds like a plan. Let's click it through.
Magic, thank you. Did I accidentally hit something? Or?
No, I think it's just a touchpad.
Okay, gotcha.
There we go.
Beautiful, thank you. So we had our strategic review undertaken and released earlier this year, and it ran from basically July to January, and you know, the organisation, we took the approach that we wanted to be the model auditee, and we sat back and looked at what that meant to us, and really sort of, you know, in our role auditing the efficiency, effectiveness and economy of government service delivery, we realise that we are an impost on the departments that you represent, the statutory bodies, etc. And so we really wanted to try and apply the thinking to ourselves. And so basically from February through to July, we did our own self-assessment. So as soon as we were aware that we were being, you know, audited and the timing, etc., we undertook the self-assessment and did it as what we called a portfolio performance report. So we didn't have the scope of the strategic review, we didn't have the details associated with it, but we looked at a more strategic level. What are the key issues? What are the key areas that they would focus on? And in terms of the strategic review, we knew there'd be sort of four different areas around the actual functions of the Auditor General and the QAO, the efficiency of our organisation, and how effectively it was delivering on its mandate. We've also been progressing a case for greater independence of the role of the Auditor General, and so we were fairly certain they'd be in there. So based on those sort of 4 key areas, we actually undertook our own process and really looked at what type of key strategic questions were there, where we were doing well, where we felt we needed to improve, or any key issues in that space, as well as the performance information that we were already running and managing our operations by, or any new information that we needed to assess. And so that served us very well. So rather than a sort of a mad, flat panic that we see with some of our clients towards the end of the performance auditors, we're still trying to gather information and they may not have it, so they're busily trying to pull it together or make it materialise out of thin air in some cases. We had pretty much all of the performance information that our strategic reviewers, Philippa Smith and Graham Carpenter, were looking for. And for us as an organisation, it was very useful because we weren't in that mad panic as we had people off at leave at Christmas time and those types of issues in that space. And so hold that thought as I work through that second part of my presentation today. So what did the actual audit find, or the review find? Is that the right one? I'm just going to go straight to those. There were basically 4 areas that we took out of it, and it was interesting from our perspective because you know, the person receiving is generally not good when they're normally the person doing, and there was, you know, that emotive sort of response to some of the words that were written in the draft reports and all of that sort of stuff, and we sort of had to make sure we sort of read it, sat down, read it again, sat down and read it again in that space. But it came down to sort of 4 key issues that we saw. Number one was a significant, if you like, an emerging risk relating to our client relationships. So we try to do a lot around our relationships with our clients, because we know that it's important that to be effective, you need to have that relationship built. Forums such as this, structurally built around sector directors that are available to yourselves to help, informally and formally assist you in your role. And a range of other areas that we do. We get very high customer satisfaction scores for our parliamentarian, for our public sector, for our different stakeholders. But it was flagging an emerging risk around, particularly as it relates to directors general, etc., that we need to sort of really put more energy and effort into those relationships, as failure to do so over time would, you know, work to our disadvantage and in achieving our vision of better public services. The other area was around our funding, so the funding of the performance audit program. It reflected that the recommendation that you'll see is basically doubling of the performance audit appropriation. So you may be aware we're funded by both appropriation for our performance audit program and by fee for service in our financial audit program. And it recognised that since having the performance audit mandate given to us through the 2010 strategic review, that we'd been operating reasonably well, really had bedded in the capability. But it saw an issue around critical mass, and I'm certainly with Danielle here, she lives it every day, as someone sneezes in her team. And the production line that is a performance audit program suddenly goes off the rails. So we have quite a lot of challenge with the small size of the performance audit program, the appropriation that we're able to do in being able to achieve that goal. And so to achieve that critical mass, it's looking for more funding in that space. The other areas was around funding for our financial audit services, and for the first time, I think probably in the living history of auditing, it flagged that our fees for service were probably too efficient, and that we need to relook at our financial audit fees across the business. And so we will do that as part of closing out the recommendation. Will that mean everybody's fees are going to rise tomorrow? Really can't say, and I'm not sure. In that space, I don't expect there'll be market changes, etc. But it is, flagging that based on the implementation of the standards that you've seen Karen present today and previous ones that we've worked on, generally we've taken the approach of absorbing those and still maintaining the fees, etc. On the other side of the coin, we have been focused on the efficiency of the organisation as well, and so we've been able to, in real terms, reduce our cost of operations, which then directly flows through into the financial audit fees, and that's where I'm fairly comfortable that there's going to be no sort of major changes in that space. The other area was around resourcing. So both across the financial audit and the performance audit, the key issue we have is around attracting really good talent. Our ability to hire lateral hires from different external organisations, generally the private sector, with the competition for talent, is a little bit limited by the conditions of employment that we're able to provide to our staff. And really the driving this, if you look at the root cause issue, the resourcing issue for us really needs to be resolved. Our only leverage is generally the number of graduate auditors that we hire, and we've increased those markedly over the last couple of years, and invested heavily in our learning and development and also our competencies for our staff. But it is like shooting something from 20,000 feet. You've got to really try and get the number right today to be able to ensure that you have the right auditors in 2 years' time, 5 years' time, 10 years' time as well. So sitting behind all of that is the fourth area around basically confirming the need for greater independence of the Auditor General role, and also of the office that functions at. And that would enable the organisation to start to refine and better reflect those conditions of employment around a modern audit practice, more so than the public sector or public service conditions of employment that we currently have. So they're the four key issues that were described, and we'll continue to progress those, and I've responded to that report and publicly supported those strategic recommendations, which was very easy because most of those are for others to do rather than myself specifically. But overall, it found that the organisation and the role was very fundamentally sound, and that it achieved a great level of efficiency. And I think as it translates to yourselves, you can be sort of comfortable and confident from that assessment that in terms of the audit quality, the efficiency, and therefore the flow and impact into your audit fees as well has been independently assessed and found to be very solid. So back to the performance audit, I'll just give you a quick look at those recommendations before we go. They're the strategic, and there was also a number of operational ones, but they really describe the key issues and the direction that the strategic review is. And if you think to the previous strategic review that we had, the performance audit mandate came in as a result of the previous strategic review. And so we're hoping that these are supported, but it is in the hands of currently the Parliamentary Committee for response, and then the government of the day to make a decision around supporting those as well. I wanted to introduce you to this. Has anyone seen this type of diagram or something similar? Back to the issue around the case for increased focus on performance reporting for audit committees. It's a really nice, simple way of describing the governance framework, and it says basically this is that if a governance framework is operating well, it looks at the stewardship of the entity that you relate, and the vision and strategy, how it's designed and implemented, projects, operations, services, those types of things, and the performance monitoring and review associated with that organisation. It looks at the conformance, so the compliance and the work you're going through at the moment around the financial audit, assurance with financial statements, those types of things is a key element of that, as well as compliance with regulatory frameworks and those types of things as well. And the third dimension is around the performance, the economy and efficiency, the cost effectiveness and the equity and access to those services that are in place. And so if you sort of think to your organisations and recognising that from very small to very large, there'll be different roles and functions in audit committee, it's worth just reflecting where you might sit in terms of the terms of reference of your audit committee and the focus. but also importantly, what other governance mechanisms are sitting within your organisation that you may interrelate with that cover off the scope in that space. And I'd like you to keep thinking about that as I go to the Queensland Treasury guidance. I think covers it really nicely around audit committee and risk functions, if you like. And they have 7 different areas that audit committees should be focused on, but they also recognise that some of these may be within the focus of an audit committee, or they may be covered by someone else. The first area is risk management, and clearly, I think as we've spoken before, it may be a function within the audit committee, it may be a function outside of it, and if there's a separate risk committee, that's fine. The function's covered. The second area is around internal control, and I think this one, sits smack bang in the audit committee space. There is no delegation of that, and so the overview of the scorecard type information that Karen's giving you, the red light, traffic light system, is a good example of how we can support you around your role of internal control. If you look to the reports to Parliament that we produce and the results of financial audit, you'll see one of the key themes or issues that we have at the moment is the timeliness of resolving the deficiencies associated with internal controls. And I'm starting to see those sort of creep out longer than 12 months in a lot of cases, but it does vary by sector. And so looking at, summarising the themes that we're finding in terms of the wider learnings is you really should understand and get into those internal controls, and particularly gain assurance for yourself as to the timeliness. If they're sitting there longer than 12 months, then there's probably a suspicion or a concern around your wider internal control environment. Both Karen and Danielle also spoke about the asset management, and particularly Danielle around the asset register. This is an ongoing focus for us. It's our most material management assertion in the financial statements, and we'll put more and more energy into ensuring that they're accurate and complete, and that we can have confidence in them. And certainly that's why we've invested the time and energy in the asset valuation guide, which we're going to promote and push heavily to provide all of the things that you were afraid to ask but really needed to know around CRC, both at the practitioner level, the people that need to actually perform those, but also for yourselves. I think it's useful as well to familiarise yourselves with some of the key concepts in there as it applies to your organisation and its use of CRC. So I really do hope you take the time to study it, and certainly provide any feedback to us around that. We're putting it out as a draft for consultation, and it may be a case that, for yourselves as audit committee chairs, that, good in detail, but there's something else that we need to see, and I'm very open to progressing that forward as a series if there's something more required, or even, some summaries that might assist you, checklists, those types of things as well, because it is a key area that we need to improve on in that space. The third function around the guidelines is around financial reporting, and so I won't spend too much time on that because obviously you're all across that, particularly at this time of year. But certainly timeliness of reporting is the area where we're focused on the moment. Last minute leads to poor quality is the essence of what we're driving at the moment, and so you'll see we're working with each of your entities around agreeing what that timetable is, so that we're not caught by the last minute and having to make quick decisions, or having to deal with it next year, or pushing it on in that space. And so again, if you're not familiar with the timetables, not just for this period, but we are moving those forward to smooth our audit work program, but also smooth your workload and the workload of the entities, departments that work with you in that space, to ultimately improve the quality of the financial statements. The fourth area that the guidelines talk about is performance management. So it is very clearly and specifically put in the space of the audit committees. And I reflect on obviously working under terms of reference, and again, you might be performing well or somewhere in the middle. But I asked the question, since the Auditor General mandate was updated to include performance auditing in its role, How was that reflected against your own terms of reference, or was it? Is there anyone in the entities or within your governance framework that is focused on the performance auditing side of your function? What we see a lot of times is the audit committees will look at the reports, they'll look at the recommendations and discuss them, and they might follow them up as well. And I see that as the minimum requirement. If you look back to the reflection on the strategic review, I would say ask yourself, looking at our strategic audit plan that Danielle presented, the proposed topics that we're looking at, if you think of those as, particularly if you have the risk mandate within your audit committee, is we don't make these up from, gee, this would be a great thing to look at, is we do a very comprehensive environmental scan of international trends, Australian trends, state-based trends, sector-based trends. We use our sector directors, we use our referrals, we use our inputs, external research, etc., to identify the things that matter. If a topic then through the prioritisation process actually ends up on our strategic audit plan, it's because the financial, the social, the economic impact of that is of enough concern to us that we want to have a look at it. So you can pretty much say with confidence that we've looked at it and it may be a significant risk to your operations. We don't get it 100% right all of the time, but with a very limited performance audit appropriation and budget, we do look for those areas where we can shine the spotlight on government service delivery that could be improved. So I would encourage you to look more proactively, if you're not doing so at the moment, around that performance audit program, because they do represent key risks to the entities that you work with. The next area of functions is the engagement with internal audit, and particularly in evaluating the quality of the internal audit function, and also the planning and monitoring and reporting. And so this is the key leverage mechanism that I see for yourselves, is as you look to the internal audit program, etc., and you cast your eye up to the proposed strategic audit plan, is there the opportunity to do that self-assessment within your organisations and drive that assurance of the service delivery of that entity by using that internal audit program. And so strengthening practically the alignment with our strategic audit plan and those types of issues is one way that can be achieved. And obviously the ninth area is around external audit, and I would hope that sessions like this demonstrate that the importance of the relationship to us and across noting the mandate of both financial and performance audit. And then finally, the 10th area is around the legislative and regulatory framework. So making sure that conformance side is covered, that you have confidence that the entities understand the legislative and regulations that are applied to them, and that they've got active processes in that space. So again, if you're across all 10 and are doing them sterlingly, congratulations and well done. But I did want to just stop and reflect, and whether it's yourself or another governance committee in that space, I think it's important to, one, get over your financial statement assurance, but two, as you move past that over the next couple of months and before our next audit committee chair, is actually stop and reflect on your terms of reference on the value that you're adding in that space, and certainly how we can better support you in that area. Against those sort of 10 key areas. And if you look back to the myriad of requirements, whether it's the F&A Act 2009, the FPMS, the Treasury Guidelines, there's a range of things, the Performance Management Framework. Each of your departments and statutory bodies should basically be complying with those. But time and time and again, as we spoke about last time and Danielle's reiterated on, is the performance reporting and performance information is the massive gap. So if we do actually want to optimise how government service delivery is done, the translation of taxpayer funds or ratepayer funds to the provision of services, the energy into performance information, performance reporting, I think is well spent. And if I look at casting out over the horizon, you may be aware that there's things like Exposure Draft 270, reporting service performance information for NFPs. It's having a difficult birth. There's a lot of debate and discussion, but it's looking to essentially mandate reporting information. It will have a big impact on government, particularly if it's turned into a standard. I won't comment on the probability of that, and I don't look at whether it's going to hit or not, and I hear the commentary around, look, we don't think it'll ever get up because it's had so much of a kickback. But I do plan on scenarios, and so whether it's ED 270, whether it's something in the future, there is a move more upstream from the financial being the result to understanding the activities, the outputs, the outcomes associated with achieving that result. Whether it's ED 270, it's the push on integrated reporting or a range of other areas. I think it's coming. And so we can either, as a state, be in a very reactive position, and I think Karen's discussion around related parties standards sort of highlighted the standard started on the 1st of July, and we're still looking at the administration impacts and consequences associated with that, and nobody, I think, accountable for it realise the I guess the emotional or the other impacts above and beyond the financial. Magnify that by about 1,000 times, I think, if you're looking at the reporting of performance information, because as I spoke about last time, understanding the value-adding processes that you do, how they're best measures in terms of the outputs, the activities, the effectiveness of it, I think will be quite a significant challenges for organisations. So as we move forward more and more, I will absolutely focus on bringing better maturity capabilities to the performance reporting, and I'd really like to garner your support for that as well. So in closing, I'll probably have two key questions, rhetorical of course, you don't have to answer to me, is really bringing it back to where does your audit committee sit in that wider governance framework that I've put there for you. And can your role be strengthened today as it relates to the performance reporting, whether it's a better integration of strategic audit planning, the expectation of assurance around the performance alignment to performance requirements set by the Queensland Government or wherever. What can you do practically today with a view to that future? So thank you, and very happy to answer any questions around that or any other areas as well. All good. Right, well, thank you very much for your time. Oh, sorry, Bob. Sorry. Oh, sorry, there was one. Did we miss a slide? No, I didn't see one. Ah. So I offered Bob a shameless plug, so you have the floor, Bob. Sorry, I thought there was going to be a slide for you.
Thank you, Tony. Folks, I normally don't do this, but there's a unique opportunity for Audit Committee chairs and Audit Committee members in Sydney on the 24th of July this year at the International Convention Centre or Conference Centre. The Institute of Internal Auditors runs an international conference every year around the globe. This year it's in Sydney, and on the first day, Monday the 24th of July, they are running an integrated audit committee day. So that day will allow, when you register, allow you to attend the first keynote session, which is about the future is already here, so what about tomorrow? Then there are 4 standalone, that is, you have to be an audit committee member registered to get in there. However, if your head of internal audit has already registered for the conference, you can bring him or her with you to those closed sessions. The 4 closed sessions will be on cyber security, organisational culture, particularly the relationship between the board, the Audit and Risk Committee and internal audit, setting the risk appetite, which I think is still a common commentary, responding to innovation and disruption. And then the final session for the day will be back in with the conference session, which will be a Bend It Like FIFA. Jonathan Calvert, the gentleman who led the media team that identified all of the issues in relation to FIFA. It is an affordable conference. It's a unique opportunity for us, specifically as Audit Committee chairs. So if you do a search, a Google search on the 2017 International Conference ARC Forum, you should find the brochure. If you want to make sure you get the link, please give me your business card or I'll give you my email address before we go. Thank you very much, Anthony.
Thanks, Bob. And look, you heard it here first. You know, they're probably already sold out, but if you talk to Bob, he'll get you in. So thanks very much for that, and I think that'll be a good conference. So thank you, everyone, for your attendance, and I hope you got a lot out of the day. Thank you.